because you have very highly leveraged balance sheets relative to what was going on before, you have a group of debt investors who may have always been prepared to own a company or be prepared to go through a distressed transaction. Number two, I think there is among a lot of investors some fear of the bankruptcy process, not because they're afraid of the process, but they're afraid of the cost of the process and the lack of control. And by creating a prepackaged situation, whether that prepack results in a debt for equity exchange, or whether that prepack results in a M&A transaction, they perceive that as sort of shortening that period of time during the Chapter 11 when fees are accruing for professionals and litigation is going on, et cetera, et cetera. The downside of that is that the underlying operating fix to the company doesn't occur, or at least doesn't occur in the context of the restructuring. I think as you look about the tension between, are the lenders going to credit bid versus are the lenders going to drive a sales process, that's a little bit driven by value and a little bit driven by what people are interested in. So if they can run a sales process and get taken out, well, that's a great thing. If they run a sales process and the sales process is somewhat unsuccessful and they don't get good bids for the company, then perhaps a credit bid is more important. One of the differences, and you might want to talk about this, Andrew, one of the differences between 6 months ago and today is we actually have a little bit better visibility on what those values are like, and therefore what a good deal and a bad deal is.
Well, first, I echo that. My sense is you're seeing more prepacks in part because fresh in the memory is interstate bakeries or Delphi and any of these protracted free fall type bankruptcies that are very damaging to all the stakeholders because of just the expense associated with it, Scott, as you point out, and the fact that the businesses, even though they're operating under the protection of the code, you know, they have customers and suppliers and employees, and it's hard to hold that together. So being in a bankruptcy for 4 or 5 years can be very detrimental, and it's risky for everybody. The contentious nature, the fact that we're seeing greater, my sense is the reason we're seeing more and more alternative plans is because the market has come back, at least the credit markets have come back so much more quickly than people thought. You have some situations where there was a filing and now bonds are trading at 50 cents on the dollar when they were in almost nowhere, and so now unsecured creditors are saying, hey, wait a minute, there's some value for me. There's also just a lack of consensus about where the economy's going. And so reasonable people can have reasonable differences.
Either up, down, or staying the same.
That's right, exactly. And so when there's a lack of consensus like that, you're bound to have, it's the old joke about having 5 economists and having 10 different opinions. That's kind of the way it works when you have a room full of creditors with different claims in the balance sheet.